Cross Country Mortgage is putting up our own money, lending on this product. So a lot of people call it a non-QM loan. It's also a portfolio loan as well because we service that mortgage directly. So we know our appetite on what we're going to lend. And here's the best part. With these products, I've taken non-warrantable condos that I was told would never fund. We just did one in Miami a couple months back, and I've done 3 loans for this guy. Same situation, right? Turned down by 3 traditional lenders. We got the deal. Self-employed guy had 7 businesses, and I'm like, look, I'm not even touching that with a 10-foot pole. I don't want 900 pages of tax returns. Just send me 12 months bank statements, right? Let's do this the easy way. Let's use one business, not all 7. And we got a condo that was historically non-warrantable. And with a couple exceptions, we were able to get that purchase closed. And the gentleman that I'm speaking of still lives in that condo today. And everybody that he talks to who tries to buy in there with a mortgage and not pay cash, I get a text message from him, and Brandon goes, "Hey, Chris, got this guy calling. They're looking at buying on my floor, maybe the floor below me. Their current mortgage lender turned them down. The HOA said to call this guy across country because he's got this unique program." And boom, that's how my business has skyrocketed from your normal FHA purchase, your normal conventional first time home buyer, to now offering programs to where when other people say no, we say yes. You know, go
Chris,
ahead,
I
Tess.
have a couple questions for
Fire
you.
away, girl.
So, with FHA mortgages, which most of the people on this screen are very familiar with, and also even with some conventional mortgage types, a factor that comes up is the condition of the property. Because, right? So, is that also the same with these DSCR and non-QM, or do we have more wiggle room? Like, can the property be in crappier condition before we have to ask you about like the reno loans, which I know is also gonna come up? Because
So
we, especially here, I just want to like most of the people here are Philadelphia based. We do have a couple Delaware, but the city of Philadelphia is notorious for people that just like to call themselves real estate investors. And essentially, there's someone that caught a YouTube video or heard through the grapevine that, oh, you can pick up this house. And we also have a plethora of burnt out, rundown properties that do need to get bought and renovated. But people think that they can just call someone like you, get the money to for the purchase price, which could be anywhere from 30,000 to 90,000, depending on what neighborhood that this piece of crap house is in, right? And they can just ask for however much more money they want on top of that for renovations, and bada bing, bada boom is supposed to be easy. So we know we can't do that with FHA because they get mad at us if there's chip paint on the back step, and we got to worry
right.
about that, right? And then even with conventional, there has to be like working appliances, and there can't be a gaping hole in the roof. So what condition do we need to worry about, and how does this play into people that want to buy something and flip it that might not even be in living condition right now?
So the best way to answer that is when you do a conventional loan or an FHA or a VA or a USDA, that appraiser is appraising that property against specific guidelines, right? Fannie and Freddie all have their appraisal underwriting rule book in which that appraisal needs to meet all of those checklist items for them to assume that, hey, the house is safe for the borrower to be able to move in, and obviously that the value hits. Because this is a portfolio program, this appraiser does not answer to anybody, and there are no real, governing bodies kind of above the appraiser in this situation to where we would have that issue, right? Like, obviously, if the house is dilapidated and falling down to where like the whole kitchen ceiling fell in and you can see upstairs, yeah, there's going to be a little bit of wiggle room. Like, hey, you may need like a whole construction loan to renovate this property. But perfect example, I did a purchase for a lady down in Florida last year. She bought the house as her primary residence, renovated the whole thing. House isn't done yet. She spent 400 and some odd $1,000 on the renovation and was like, Chris, I need to get some of my money out to pay off my credit cards. She said the house isn't finished. So I know in my mind, I can't go FHA, can't go conventional because the house doesn't have the bathrooms in, kitchen is half in. And I said, you know what? Like, let me take you through one of our non-QM programs. Luckily, she's self-employed, so I kind of did the same thing. Went with the bank statement loan, and that property is not even finished yet. We're closing on Friday. And, she's like, how do you even do this? And I think the number one answer to that is cross country doesn't ever want to say no. They always want to be able to find a way. I always make a joke and I say it's harder to deny a loan here than it is to approve it because our denial process, you have to go through two underwriters to look at it before they will issue that denial letter. And it just comes off of sheer size, right? The statistics this year was 1 in 40 transactions that happens across the entire United States is originated by a cross-country mortgage loan officer. So when you think of what it takes to be the number one lender in the country, we did like $54 billion in originations last year, which is just absolutely insane. So when you're that big of a lender, right? Like you're dealing with investors and people that, have these unique nuanced programs that when you just start bringing everything on board, it's like we're just getting additional tools in our toolbox. And, whether it's a bank statement loan, whether you're qualifying just off of the assets, let's say you have a huge settlement, you have $2 million in a, trust fund, but you're not actually working. Well, I can take that $2 million and I can break that out into a gross monthly payment to say, hey, if you were to draw on this trust fund, let's say, and the amount of money were to last for 3 years, you would be making roughly 26,000 a month. That's what I'm going to use to qualify. Same thing for a bank statement loan. How much are you bringing into your business rather than what are you showing on taxes? I don't know if you guys deal with any, ITIN or DACA or foreign national clients, but everybody's got a different visa, right? Okay.
Well, if we can get to them before ICE does, we might be able to still do that because God knows we have the diverse population that needs that.
Yeah.
But I don't know if I missed it because I was just like uh, dealing with the chat and some stuff. But the LTV on these, what's like our min and max?
So the min loan to value is 15%.
Okay.
So it is a larger down payment, right? Obviously, there's more risk involved. So the more risk normally means the more skin in the game. So as far as down payment goes, the minimum is 15% down. A lot of people do 20. If it's like a multi-unit up till 4 units, it is 25% down.
Okay.
We will also do this product up to 8 units. So
Okay.
I've done a couple DSCRs where people are buying like a little apartment complex, 6 to 8 unit spot, and we can use this program as well. Um, One of the things that I want to touch on is with the DSCR, we can also close in an LLC's name. So the majority of the investors out there that are buying houses, right? They're not trying to close in their personal name. They're trying to close in the name of their business. It's less risk. It's taking them out of it and it's saying, okay, my LLC is the lender. The LLC is the one that's buying the property that the house is titled in. So therefore, if something goes sideways, everybody's coming after the LLC, not the client. So I can probably count on one hand the amount of lenders that I know that will do that and will, consider that a loan in-house. All of these loan programs that I'm talking to you guys about, we underwrite and process in-house. I call my cross-country mortgage underwriter, my processor. Everybody is working on these programs, which is what gives me so much flexibility. Back in the day, when I was at Guaranteed Rate, we had an asset qualifier program. We had a bank statement loan, but I had to broker that out. I had to use an investor that wasn't Guaranteed Rate at that point. And the loan process took 60 days. It was messy. The agents hated it. The client didn't want to work with you afterwards just because of the fact that it took so much work to get it out. I've got these things spinning on a dime to where I can close the DSCR in 2 weeks. And, if you're an investor or if you're, working with a client that has a portfolio of rental properties, There's no emotion in that decision, right? It's strictly business. These people want to move fast. They don't want to wait 30 to 45 days to buy that house. They want to get in there, renovate it, get it back on the market, making money, right? That's an asset. They want to be able to close fast. Being able to do this in-house gives us that opportunity.
So I know that there is at least one person, or might be two, that are actually not agents, and they came tonight because they are interested in potentially having to use a product like this. So talk to us in, like, I'm going to say layman's terms, and not because there's a lack of education here, but like real terms, because like I said, I do know the agents on this screen. So when Jane Doe comes to Karana and is like, hey, I have $25,000 saved. I found this property. It needs major renovations. I think I can pick it up for 80. What does that look like? They're going to ask me, or Q's going to say, hey, Tess, can you look at this and give me an estimate about how much it's going to cost to renovate it? And if it's our typical row home here in Philly, even if it is obliterated, we can get them flipped here for 100 grand. So I say you're going to need 180,000 altogether. Comps are going to be 245 to maybe 260, depending on what you do with it and what happens the next couple months while they're fixing it, right?
Right.
Those numbers, is that something that fits right into this? And are they going to be switching out of like one of these non-QM situations to a home reno loan if the numbers work right? Or are they going to need the cash to renovate in conjunction with financing the purchase of the property?
So our reno programs are absolutely fantastic. We do so much reno. We have a division that will assist me per se
Mm-hmm.
in that whole ordeal, right? Because most clients when they come looking at a house, they either don't have the money for
Yeah.
the reno or maybe they don't have the money up front, right? So
Right.
we have to find different programs out there that can kind of fix all of those voids. The renovation property program is great because it's looking at that ARV, right? It's looking at that after renovated value, and it's
Yeah.
saying, okay, cool, you just picked up the house for 80, you got 100 in it, it's worth 240. So then
Yeah.
at that point, once they close and everybody gets paid, they're going to be at a higher interest rate. I'm tag
Yeah.
teaming the DSCR loan at that point, dropping them down to that 6.875 and then saying, look, this is your program for the next 30 years. Obviously, if we want to take money out, it's a good opportunity to be able to do that at that time as well.
Yeah.
But I normally tell people our reno program, I'm keeping that for 12 months or until the job's done and obviously the house is finished. And
Right.
then I'm putting you in a more long-term program because that reno loan right now, you're around 8.25 to about
Yeah.
8.75, depending on which one you go with and
Yeah,
how much the renovation.
it's a short term solution, and then it depends if
Correct.
they're gonna buy and hold or flip it and to
Yep.
sell, right? And so if you're an agent on the screen, when you're used to dealing with a primary residence buyer or something that doesn't need to get renovated, and even if it is an investor, you're used to running comps one way for the current condition of the home, so you can see what offer to put in. When you're talking about these investor situations or people that are going to buy something and need to renovate, you need to run two different numbers before you even let them go bother Chris, because you need to know if there's enough margin for how much the purchase price is and then what brand new renovated comps are in that same neighborhood or whatever, right? And you have to run the numbers tight because there's going to be less room for deviation. You can't fudge it. You're not going to be able to, if you're in city limits, you can't go find a house 2 miles out in a completely different neighborhood, right? You got to keep your numbers right and tight, and not feel pressured to tell this potential client something just so they like that deal or buy the house. Your job is to make sure that they're making a good investment. So when you're running comps, you're going to run comps at the same crappy condition as the current house that you're looking at that your person wants to buy, right? You're going to run comps and see it. Does it make sense? Is 90 really the number for this, or are they selling for 65 and this listing agent is nuts, right? So you need to know that. And then you need to run comps for that same address at what they are flipping at. So what are the brand new renovated homes selling for, and what's that margin, right? So you make sure that you have more than enough money for the renovation and closing costs. Does that make sense? Somebody nod their head. You only have two of you on the screen. You guys are being
Yes.
Yes.
okay. Yeah. So you can't just come, because this happens weekly with one of you guys. You say, hey, coach, I have this investor. He wants to buy this house, blah, 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 blah. And I look at it and I'm like, well, how much is he offering? And they're like, well, the asking price is this. I'm like, yeah, 90, but brand new renovated houses in some of these Philly neighborhoods are selling for $115. There's not enough money between a 90 piece of crap house and $115,000. They're gonna put 115 into almost 115 just with buying it and closing costs. And in a couple months interest, they're at $115. There's no room for them to get money or even put their own to renovate to flip that. Now, if they want to buy it at 90, spend their money and then rent it out for an extended period of time, they'll get their money back eventually, right? As long as the rental numbers make sense, but that's not going to be a flip situation. So you have to look at the numbers, and it's not your job just to tell people what they want to hear. It's your job to protect your client and their money and their investment, right?
Yeah. The other good part about that test is, obviously we want to make sure the numbers work up front, right? So I've got a calculator that you could call me. Let's say Lanique calls me on Tuesday. She's like, hey, Chris, here's the purchase price. Here's how much we think it's going to cost. I'm going to run all the numbers out with all the, overages that we need to have on board in case that there's a mistake and all this extra money that we need to keep in track. And I'll be able to say, okay, does this make sense as a flip? Does it make sense as a buy and hold? And it's literally a red no or a green yes.
Mhm.
So when I get that, it basically analyzes it like that. So I can say, okay, my short answer is yes. It does make sense either on the flip side or on the refi side. And then at that point, I talk to the client and I'm like, okay, cool. Like, what's your plan? Are we trying to make quick cash and we're just going to flip it? Or are we trying to do a buy and hold to where you need this product up front and then we're able to do a DSCR in the future? Um, Another one of the products that we have kind of under CCM, not through CCM, is we have a fix and flip program. So this is basically like Tess was talking about, a construction loan per se, that you're buying the house with 10% down, and then we're financing 100% of the renovation.
Mhm.
So you may find that property for 90, you're putting, 10% down. There are points up front. So you're putting 9,000 down plus a couple points, but we're financing 100% of the renovation. But granted, I'm also using this calculator to say, okay, cool. You're putting 100 into it. Are we making sure that that house is going to appraise at 230, 240, 250, whatever the case may be? Because what do we not want to happen? Last thing we want to do is lend money and then that appraisal come in at 160 and you got 190 out on the street. You're underwater at that point,
Yeah.
right? Nobody's making money at that point. We're all losing money.
Yeah.
So my goal is to kind of give you the yes or no thumbs up, like, hey, this does make sense. Let's take it a step further. Or maybe we need to pump the brakes. I don't see the future valuation being there. This might not be a smart buy for your investor. The best thing you can do for your client as a realtor is to protect their money. If you're protecting their money like it's your money, that person's going to keep coming back and back and back, and they're going to keep using you for properties because they know that you have their best interests at heart. My job is to make you guys look good, right? I'm obviously here to knock out the loan and do the best I can on that side. But when it comes to standing up in front of your investor, we're a team. If if I'm working with, Tess with the client and he's like, oh yeah, she's showing me the houses, Chris is knocking out the numbers, like that's a powerhouse team right there. That investor is going to come back and maybe buy 5 houses a year. I've got investors that do 10 deals a year with me. It's just a matter of what month it is. Is it going to be two or one? But I know, rinse and repeat, they're buying a house, they're flipping it, or they're buying a house and they're holding it. And I know which program I'm going to use with each one of those investors.
Lanique, you got your hand up there?
Yes. So I have a client, and I know Tessa asked me to ask a couple questions, but in case this happens to anyone else, they were recently incarcerated. It's been over a year, but due to their record, very few people will loan to them because they have a criminal record. And then they do make money. Would you advise that this type of loan works best for them?
Non-QM, 100%. Was it for a financial crime?
Um,
That's
partial.
normally the number one thing that is a disqualifier, like across the board. Like if they committed mortgage fraud, right, and was sentenced to that, or
Yeah.
some sort of financial stealing or
Like
something bad,
embezzlement, money laundering,
money
stuff like
laundering,
that.
yeah, that's normally
Yeah.
like 100% no across the board. If it's like they got a DUI or, they got an assault charge or something like that, a felony, non-QM is the way to go. If I can't do it, normal conforming. But normally, if they're making money, I would lead them towards the non-QM side, and that's the way that I would rock with that.
Thank
Of course.
Chris, if you were an agent trying to exponentially grow your pipeline, what would be the best way to advertise that these are the type of clients you want to work with? And what is the best way to, if you don't have a sphere or a high following on social media, to put yourself in a position to meet people who are going to want to use these products?
To be honest, I'm probably going to investor seminars. I'm going to go to the Burr method and I'm going to join all of those Facebook groups.
Mhm.
And those are the people that I'm going to start doing business with. I'm going to find any investor, any contractor that's trying to do flips, and I'm going to offer value, right? Hey, where are you looking at properties? Oh, looking at Fishtown. All right, cool. Let me go down and let me send you a, CMA of all the houses in Fishtown that just sold over the past, 12 months, right?
Yep.
Or I'm going to go into that investor group and I'm going to say, how are you guys reviewing your financing? What products are you using? Oh, I'm hard money. I'm paying 14% and 4 points. I'm getting killed. Well, have you ever looked at a non-QM loan that may be more advantageous to you? And you're basically asking those open-ended questions because you want them to find out more, right? You want them to be like, that's a great idea. Why don't I call Tess and say, hey, like, what do you got in this situation? But,
Mhm.
me personally, I kind of had a paradigm shift at the end of last year as well. And, I was like, hey, a large portion of my business is helping first time home buyers and kind of everything that entails. And that part's great, but like anybody can do that, right? You can go talk to any lender and they can do an FHA loan. There's nothing sexy about that. Being able to originate non-QM loans just as fast and as aggressive as I do conforming mortgages, that's the sexy part, right?
Yeah.
Taking people that get denied from other lenders and turning them into homeowners, that's my value add, right? Like when I'm talking to you guys as my clients, I'm saying, Lanique, if I can do a loan that, so and so down the street can't do, then that's how I'm adding value to your business. If I'm looking at Doris and I'm saying, hey, Doris, you got a client that hasn't filed taxes in 16 years, but they've got $150,000 in the bank and they want to start making money. And everybody you talk to, as soon as they hear no tax returns, they're automatically denying that client. That's the person that I want to talk to. Now,
Mhm.
granted, am I going to be able to do 100% of these? Of course not. I'm not claiming that we'll do every loan. But can we get the majority of these deals done when other people say no if the situation lines up? 100%. And that's what you can take to the street and start offering those expanded products, right? Hey, this isn't a normal conventional loan. This isn't going to fall under those normal guidelines that you've been denied for before. You got to have a little bit more skin in the game, but
Right.
we can get it done. And then obviously, most of the issues that would lead people to using a non-QM can be fixed within time, whether it's credit, down payment, bankruptcy, foreclosure, whatever the case may be. But this could be a bridge in that gap to be able to help out when the normal answer is no.
Alan, you have your hand up?
Yeah, I have two questions.
Oh, it's
Um,
Alan.
yeah, I don't know
Alan.
why the E
It
is
says
missing.
Alan. The whole time I was going, who is Alan? And why is it spelled like that?
I don't know. I
It's
don't
literally
know.
Ali.
Hey,
Hey
only
girl,
me.
hey.
Hey. So, Chris, I have two questions. Maybe you said it in the beginning and I just missed it. What does non-QM stand for?
So non-QM is just a non-qualified mortgage.
Non-qualified mortgage. Okay, I need to write that
So
down.
think of
And
like conventional VA, USDA, all of those loans that you hear about all the time, all of those are conforming mortgages. They all
Mhm.
either roll up to HUD or Fannie or Freddie. So
Ellie,
those
when
are
I'm,
all your
yeah.
normal standard guidelines. Anything that's not that is labeled non-QM.
You
Got
know how
you.
I remember who needs to talk to him for what? As soon as they start saying they have no tax returns, or as soon as they say self-employed, I go, in my head, I look at the buyer like, well, you're not going to be qualified for the regular stuff, so you got to go this way. So even though that's not what that non-QM means, that's how I remember it and know which way to go with people. As soon as they start talking that their money is a little funny in some way, shape, or form, I'm like, and you're not qualified for conventional or FHA, so you got to go talk to Chris. That's just how, and it's
Good.
not the same as hard money, and people use that term way too loosely. And agents will also make a mistake and write offers saying that it's a cash deal when in fact it's hard money, which is still being financed. So you have to put that, like, you guys make mistakes with that all the time. And some of you get in arguments with me, like, no, it's cash, it's hard money. I'm like, it's not your cash. It's not your
Cash. You still
client's
have to go
cash.
through the
If
underwriting
it's not,
process.
if your client is not showing up with a certified check from their bank account to pay the full amount at settlement, that's not a cash deal. That's financed. Every other thing is financed. Cash is cash, period. There's no like fudging that. But I always do that in my head. As soon as they start talking funny, I'm not talking to them anymore because I stay in my lane. I don't pretend to be the lender either. I stay right here. And as soon as they start talking crazy, I'm like, you gotta go talk to a money person about that, right? And then you had a second question.
Yeah, the second question was, you had gave a suggestion when you go into these investor circles, to ask, you could put together a CMA for the last 15 properties in said neighborhood or zip code. I
Yeah.
couldn't remember everything that you said, but
It would be comps.
right. Okay.
Yeah. Yeah. So wherever they say they want to purchase or start investing, you would give them a snapshot of the neighborhood. Just like I said, let them know what the going rate is for purchasing something and then what happens once it's renovated. Show them if you know they want to buy and hold, then you want to show them what the rental rates are as well, because most of our investors are going to want the ratio for rent and their mortgage to be at 1%, meaning if they're going to be all in for 200,000, a minimum amount of money that building needs to be producing is $2,000 a month in income. That's the 1% rule. They would love to be better than that, but it's no less than 1%. And then it doesn't make sense. You understand? You want
Yeah.
at least 1% of rental income coming into that building compared to what they're all in for, or what their mortgage is for. Does that make sense?
Yeah. Yeah.
Yep.
Thank you.
Yeah. Q, your hands up.
It sure is. Um, Question for Chris. And I might have missed this, so sorry, but I literally just met a buyer yesterday, who just in the market, but is self-employed and looking for it as their primary. Does the same information that you provided earlier apply to this person if they're wanting to make it their primary?
Yes. So we have parts of non-QM that are for primary residences, and then we have parts of non-QM that are for investing, for being an investment property as well. So absolutely, we could take a look at them and say, hey, here's your situation in which you're dealing with. Here's the down payment requirement. Here's your loan term. And I would be able to go through all of that. What I kind of do up front, just so you guys kind of know, like my game plan, like you give me a call. Hey, Chris, I got so and so, X, Y, and Z. Here's the issue. First thing I'm doing is I'm sending out or I'm taking over the phone a quick application. I'm knocking this thing out in 10 minutes. I'm getting all their personal information. I'm getting their job history, what they do for work, whether they have any background in investing, and then I'm doing a soft pull on their credit. Doesn't have any negative effect on their credit score, but it gives me enough information for me to start putting the pieces of the puzzle together. That way I can see, okay, I know their income is out, like I got to do X, Y, and Z, right? Then I'm requesting bank statements. I know that this is just going to be another investment property. I don't even want taxes. They've already got 8 properties. I'm just going to rinse and repeat. I'm going to do a DSCR. My goal is to, upon approving them, is to give them 2 or 3 different loan options that they have access to. there's sometimes where people may think they don't qualify for a conforming mortgage to where, I start peeling the layers back and it's like, well, wait, you qualify for a conventional with, let's say, 5% down on that primary. Let me go through both options, right? Just so you can compare and contrast. Here's the 5% down, going with a conforming loan. Here's something that's non-QM with a little bit more down. So there's multiple ways to kind of skin a cat, but it's my job to figure out the best financing tool for them. And with a lot of these non-QM products, it's giving us a lot more yeses than it is no's. And that's kind of that benefit for me, right? Like I want you to call me and be like, hey, Chris, my client got denied last week because their tax return income wasn't good. What can you do? And then boom, I'm already rolling through it, picking up the pieces. We can transfer appraisals over, obviously title work, insurance, the whole nine. We're picking up a lot of pieces where they left off and we're closing fast. So that's kind of our benefit.
Antoinette.
Mm-hmm. And you said a non-QM loan is for people that's self-employed, right?
It could be for anybody. You could be a 1099 contractor. You could be a caregiver. You could own your own business. You could be, at a job for 7 months and have a particular situation where conforming says no, but non-QM says yes. So it's not labeled just, self-employed borrowers. That's who I think probably is the biggest use of it right now that we've seen, because non-QM's on the rise. I mean, at some point, it's probably going to get to the point where it's 50% of the loans out there are originating non-QM loans, not so much conforming with greater restrictions and things like that.
Well, that's also due to how our economy is changing so drastically, where more people are self-employed versus having W-2 income. Like the trend is to have your own business, even or at least a side gig, a additional, like almost everyone on the screen is dual career, right? So you don't have traditional income right now. You're 1099 subcontractors in conjunction with whatever else you have going on. And so it's just anyone that I put some little social media captions in the chat for you guys so that you can better understand, especially Antoinette. So it's not just 1099. It's basically if a bank or a traditional lender said no to someone, that doesn't mean that homeownership or investing in real estate is off the table. It just means you need smarter financing. You need someone to think outside the box, right? And so, because these are very functional, straight, like what they say, the shortest distance between 2 points is a straight line. So yes, again, like Chris said, you're going to put a little more skin in the game or have to pay a little more up front, but you're going to get the job done faster. Right. And it's also short term. It doesn't have to be forever. You can refinance and get into a more traditional or something with lower interest once you've fixed whatever situation caused you to not qualify for that conventional mortgage or that FHA. Lanique, your hand's back up.
Yeah. Traditionally, what is the roundabout estimate of the interest rate for the non-QM?
So DSCR example that I was using before was on a 4 unit with about 25% down. The interest rate was 6.875. So I always tell people you're gonna be normally a half to maybe a full point higher than a conforming mortgage. Like right now with great credit and 20% down conventional, I'm dancing with like a 582 to maybe a 599, depending on debt to income. So with these products, I expect to be high sixes, low sevens. Granted, with little to no credit, yeah, I mean, you're obviously going to be on that higher threshold. You might be in the 8th percentile range. But, again, this is obviously meant for a certain spectrum, right? Like if you have 800 credit score and you got 200 grand in the bank and you make $400,000 a year, you don't need non-QM financing, right? You can qualify for a normal conforming mortgage, and that's what the option best suited for you is. Perfect example. One of my realtors that works in State College, she bought a house a year and a half ago at this point, and she's like, "Look, I've been doing the realtor thing for like 2.5 years. but I write off all my marketing, I write off my mileage, I write off my car, I write off my cell phone, all my utilities. Basically, she was making 80 grand as a realtor, but on her taxes, she made like $2,000. So she's like, Chris, like, I'll never be able to buy a house. And I was like, well, let's look at your bank statements. Like, you're bringing all this money in, right? Like, you're selling $80,000 worth of real estate. Let's look at your bank statement. So we did that. I did a bank statement loan. I closed. She just came back to me in January, last month. Last month, this is February. And we did a refinance because she got her taxes done at the end of last year because she was filing late, self-employed. And we made it work. We put her in a normal conforming mortgage. So she bought the house, bank statement loan, and then refinanced into a conventional.
Yeah, it's good to have conversations with your self-employed or your business owning clients, because when I did accounting, I had the same fight with every one of my clients all the time. Soon as they needed to finance something, whether it was a car, a house, equipment, what have you, and they wrote off, they Schedule C the hell out of their gross receipts, right? So they made a couple $100,000 a year, but they were basically qualifying for government assistance by the time they filed their taxes, right? And so then they got mad at me because they wanted to go buy a house or get a new car, and their wife is screaming at them like, I don't understand, we have all this money and you can't buy me a new Mustang. And I'm saying no, the bank at the car place told you no because you look broke on paper. So unless you got cash money to go drop on the car or do this or that, you can't do that. So if you meet a client, everything is not going to be a get rich quick scheme for you, and you're not going to always have clients that are ready to go right now. So if you are talking to someone today and that is their situation, you say, okay, it's February. So this year you have to make a decision. Either you're going to save your cash and you're going to have to put that down to buy a property at the end of the year, or you're going to not write off everything under the sun this year and try to bring up the average income for the last 2 years of your business, right? So that you can get a higher average and possibly qualify for something. So you have to make a decision, and it's called tax planning, right? So you're thinking ahead, like this year, am I going to want to purchase a house? Am I going to need to get a new car? Do I need to buy equipment for some reason, right? And so you have to think ahead and make that decision. Like, am I going to pay tax money to Uncle Sam so I look like I have some money on paper and can get financed? Or am I just going to save this cash? So then you have to be a little bit more disciplined with your spending, because what happens on the flip side with most of us humans is we say, I'm just going to save my cash and just go ahead and do this, non-QM or DSCR loan or whatever and get my property into the year. And what we do, spend the cash because it's sitting around, or we're not putting it in the savings account. Yeah, we're making it rain somewhere instead of actually saving it. So it takes some discipline. And so any of you that are in that position right now, you just have to commit to giving up some money to Uncle Sam or being disciplined enough to keep it in your bank account. There's no way to really cheat that without going to jail.
The best thing that I can recommend as well, so many people when they go to buy a house, they don't really know the ins and outs of what works and what doesn't work. Like, this is the perfect time for me personally. Anybody that didn't qualify for a conforming mortgage last year, they're already been dialed by me, and I'm already calling them saying, look, I know you're getting ready to file your taxes. When you get all your W-2s together and you get all your expenses, I want to sit down with you and your CPA, and I want to go through what you're going to claim on taxes so I can give you a pre-approval, or I can update your pre-approval, right? If I'm the first step between the CPA filing and the IRS, and they're trying to buy a house, I want to be there to say, okay, cool. If this is what you claim this year, and I know what you made last year, here's your pre-approval budget. And then we can kind of, compare and contrast and say, okay, cool. Let's claim another 40,000 because that's going to get me up to that $400,000 house. And that's something that I'm educating these people on right now because they're at tax time, right? After they file taxes, they're smoked till next year. I'm not going to be able to do anything with changing their income until next year when they file for 2026. So now's the time for me to get involved and add value to that client. Let's sit down, let's have a conversation, let's look at the numbers, and then we'll see, does it need to go non-QM, or can you fly with just a normal conforming mortgage? But now's the time to have those conversations. So if you have self-employed buyers that are out there looking, remind them tax time is coming up. Have you talked to your lender about what your gross and net income is going to be so you can find out which loan program is going to best suit you.
Any other questions for Chris before I give him his evening back?
Questions, comments, concerns?
Did someone learn, or did any of you learn something new tonight?
Yes, because I didn't
Yes.
know what a non-QM was.
Yeah.
Or, yeah.
Don't get hung up on the terminology or the words. I promise you, if in your head you just say your financial situation looks a little crazy,
Mhm.
just send it to Chris or whoever you use, right?
If it starts to go down a path where you're just like, I don't even know what to tell you at that point, say, look, I got a guy that dabbles with a lot of non-QM mortgages, which sounds like you may be leaning in that direction. I recommend you giving Chris a call, set up a 15-minute appointment. He's going to ask you a bunch of questions over the phone, and that's going to best serve you as far as what type of financing you're going to need. And then Chris is going to come back to me and say, hey, here's the type of loan we're going to need. Here's the parameters, the terms. Here's your pre-approval. Go get them.
Ms. Duncan, your hand's up.
Yes. Hi, Chris. So my question is this. I am not a agent. I am a potential investor. And so um, a couple of things that you said cross. So for someone who's an entrepreneur, which I am that, I'm also a person who works in my career field as well. So I have both ways of incomes coming in. Um, and you mentioned something about um, setting your business up where it does not reflect in your own personal income. So how does that work? Are you referring to like going and getting your own LLC or something that sort so that your business, your finances don't collide together or aren't commingling, along with you trying to or working on your investment properties and things of such? Is that kind of where you were headed with that?
Yeah. So when it comes to closing in an LLC, right, as an investor, I'm an investor as well. You got a couple options. You have your DSCR, or you could do the bank statement loan in the LLC's name, going off of any of the income that's coming into the LLC's bank account. So basically, if you don't have an LLC set up yet, and the goal is to either purchase property to flip or to buy and hold, the first thing I would recommend you do is you go open up that LLC. You go down to the bank, you open up a checking and savings account. A lot of times you can even go out and apply for a credit card. There's a lot of companies out there that are going to want you to have some history behind it before you apply for credit, but there are some banks out there that'll give you a $5,000, $10,000, $15,000 credit line on a new LLC that is opened. So the good news is, right, like for me, example, right, I don't want my personal name on that property. I want my LLC to own it. I want my LLC to operate it. And I want my LLC to bring all that money in, right? I'm the owner of the LLC, so I'm obviously benefiting from that. But when it comes to, protection for me personally, let's say my tenant slips, right? It's icy. They slip going down the steps. They're going to sue me. They're not suing me. They're suing my company. So it gives you that, the corporate veil, so to speak, protection so that, your personal assets aren't tied up in that issue. So yes, I would definitely recommend if you're doing that as an investor, go get your LLC and get started that way.
You have another question? I saw your hand was still up, Ms. Duncan.
Yes, I did.
Yep.
So,
Okay.
okay. So now that we're looking at that, so when it comes to personal finances and business. So, okay, if I already have a pre-existing business, right, and then I'm establishing an LLC for my real estate or investment properties, right? That's what I'm doing. I'm separating all of that. All of
Mhm.
that is operating as separate entities.
Yeah.
This is my other question that I wanted to ask, pertaining to not just buying homes, but buying land. Is there anything different that occurs when it comes to, like, say, for instance, if that option is for me to act on buying property from the land bank or something of that sort? Is that something that runs a little different for funding, or you can't use funding for those types of purchases?
The only different with land, because we do offer land loans as well, and I'm talking standalone land, right? Most lenders out there will tell you about a one-time close construction loan to where you can buy the land and build the house with the same financing. We have a standalone land program. The only real difference there is the down payment is greater when it comes to buying land by itself. The only reason for that is there's no collateral, right? If I do a mortgage on a house, I'm holding the house as collateral. If you don't pay the mortgage, I'm coming back taking the keys to the house and the house is now mine. When it comes to land, it's kind of harder to take the land back. So the lender makes it a little bit of a more risky loan per se. So the down payment on most land, we do have a 20% down program with exceptional credit. But most banks out there will do it if you have like 40% down is kind of what they're looking for. So in order to purchase land with an LLC, you can absolutely do that. You would just need to fall into those parameters.
Allie, you have a question, and then we have to let Chris have his evening back.
I'm
Yep.
okay.
Okay, all right.
Yeah, regarding LLCs, I just wanted to ask, how old does your LLC need to be before you start applying for
So
funding?
rule of thumb is normally a year, right?
Okay.
Like
Yeah,
back in the day, they were like, all right, if the LLC's been open a year, we're
yeah.
good with it. We'll sign off on it. I've literally had clients open up an LLC after going under contract and we've closed. It's all going to come down to experience, right? When I'm qualifying a deal for an investor, I'm asking you a couple questions on your experience, right? Have you done flips before? Have
Mm-hmm.
you taken out hard money before? Yes, I also offer hard money as well. Do you have rental properties currently? I'm using all of that experience and I'm basically building, I don't want to call it a business plan, but if there's less history on the LLC, I'm basically writing a business plan for you to the underwriter. And I'm showing the, attributes. Hey, the LLC was just open, but, she put $40,000 in the LLC to purchase this home, and we have 6 months reserves, right? They're
Mm-hmm.
looking at different aspects of financing at that point. Maybe the DSCR ratio on this property is 1.25%. So you're bringing in 25% more than what your mortgage payment is on that property. That's going to be an attribute that plays in your favor.
Mm.
There's many things that we look at that I try to build the picture on to kind of help scenarios like that where the LLC might not be established.
Gotcha.
One of the things that we do verify is we always make sure, no matter how seasoned the LLC is, we're always going to need a certificate of good standing issued from the Secretary of State on that your business is in good standing with obviously the IRS, all licensing and things like that.
You need an operating agreement, and they're
Operating agreement,
getting
articles of
FinCEN.
incorporation.
Yeah, FinCEN, which is cracking down and about to make that even more strict, especially when it comes to titling and stuff with LLCs. That some title companies will like cross the line a bit and let LLCs get the deed in their name without having all the proper documentation. But there's going to be like some sort of new uploading system and compliance check from FinCEN, which is like the federal government financial security sector, if you will. And they need to not only be in good standing, but they have to have their operating agreement, which details if there's multiple members or even if it's a single member LLC, that they have the right within that company to make financial decisions. So operating agreements, so if there's multiple members, it will need to be signed by all the members, and they're going to start requiring this. I just got an email about it from One Team Abstract Inspire. And so in the very near future, there is going to be no fudging that. And it is, when there's multiple members, it can take some time unless they want to pay over $1,000 to rush an order. So it can take a few weeks or a month. It depends on the state. It depends on how bogged down they are with opening new LLCs. So you need to kind of start that process now. If you're looking to buy something with the LLC, do not wait until you're under contract. Do it ahead of time and while you're looking, so that you have plenty of time to get that formed. And also, don't confuse the fact you can have an LLC and that be what you are purchasing the home with. If you are using cash, or if you get qualified to purchase the home with your current finances, it could be personal or another company, but you can still take title in your newly formed LLC as long as you have all that proper documentation. Because that's what happens when people are doing their first investment property a lot of times, or they're buying property for the first time and they are having to do one of these non-traditional financing, using one of these non-traditional products. So don't confuse that. If you don't necessarily have to, for example, your parents can buy a home for you, but put it in your name, right? So as long as someone is qualifying for that financing part, you can add whoever you need to title to start this portfolio. That jumped in my head when Ms. Duncan was asking questions. I was like, you don't have to have an established LLC to start a portfolio. You can have a brand new LLC. A lot of people call it a holding company. Like last name holdings is really popular. So it'll be like Duncan Holdings, and that becomes a company, an LLC that only buys and sells real estate, right? And then, or they do enterprises of that nature. So when you open that, like let's say you open your LLC this week because you found a property you like and you're like, yeah, I'm gonna buy it. You know that you're gonna take title with that LLC to give you that layer of protection. Obviously, you're not gonna open it with a salon or a clothing boutique or something like whatever your other business is, but you're going to use that income from what you currently have going on in order to qualify and get the products needed to purchase that property. Does that make sense?
Yeah.
Okay, cool.
Thank
All right.
you.
Yeah, of course. So I put Christopher's contact information. If you scroll up through the chat, it is right before I put in the little social media caption, so you can save him. His website is also mylenderchris.com. Super easy to remember. MyLender, and he's got a big apply now button right in the top right-hand corner. It is the easiest thing. If you tell someone, they're like, oh, I want to get this property, and you say, is it cash? You need to get pre-approved. Oh, I need a lender. Do you have one? No. MyLenderChris.com, top right-hand corner, hit the apply now button, have them do that, and then call or send Chris a text message and say, hey, John Doe's going to hit that apply now button. So can you keep an eye out for it? He wants 123 Main Street in Newark, Delaware, or whatever you got going on, right? And then if you are one of my PC agents, this video will get uploaded into your Google Drive. If not, it is getting uploaded. We're going to make Chris YouTube famous so you can rewatch it up there, right?
Appreciate it.